the lessons that you learned in the Uranium Bootcamp and the lessons that you will learn in the Gold Bootcamp won't serve you through just one market. This will be permanent knowledge. And if you use these lessons in conjunction with the lessons in the Rural Classroom, which are free, you will become a better natural resource investor.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with Rick Rule of Rule Investment Media. Rick, thank you for coming back on the show.
Thank you so much for having me back. I trust that you and your listeners had a great holiday season.
Yes, we did. It was a lot of fun. I got to spend time with the family, but I'm excited to be back home and better for talking with you, sir. Let's start out like we always do. And what is your macro view of the world economy and financial markets today?
You know, I continue to be impressed with the relative strength of the global economy, given the challenges it's facing. I suspect that a lot of that strength is due to artificially low interest rates and artificial liquidity. But I'm still impressed that the global economy seems to have shaken off war in the Middle East and war in Ukraine, increasing geopolitical tensions and economic tensions between emerging power blocks. There's a lot to be afraid of. And the market seems to be unwilling to be afraid. I'm frankly impressed. That doesn't mean I'm not cautious, Steve. I am. But had you asked me 3 years ago what the probability is that we could get through, or even 4 years ago, if you had asked me in 2022 in 2020 what the probability is that we could get to 2025 without some form of global economic slowdown, I would have said the probability of that is very small. And we seem to have done it. It may be that we're postponing something, but since you asked me the question, I'm surprised by the relative strength of the global economy.
Okay, so despite all the macro things on the other side, the economy seems to be holding up pretty well.
You know, geopolitical tensions like the United States versus China, or, the Eastern Bloc versus the Western Bloc, or the global North, the global South, war in the Ukraine, war in the Middle East. These are not trifling issues. And it would appear that the investment community, when looking at both the positives and the negatives, continues to see the positives over the negatives.
Yeah. Okay. Let's take a look at gold. What are your macro views on gold right now?
Sadly, I feel very good about the gold trade. Maybe not for the next 3 months or 4 months, but the arithmetic around gold is unfortunately, unmistakably good. I say unfortunately because the set of circumstances that makes the gold trade work well generally makes other parts of your life work less well. And my life is very good. I would just as soon it didn't change. Thank you. But let's look at some of that arithmetic, Steve. I think it's very clear, particularly in the last 6 weeks, that the U.S. dollar continues to be the world's reserve currency. Money is flooding into the United States from around the world, perhaps or perhaps not, as a consequence of what they think our president might do. But irrespective of your politics, no one can deny that money is flooding from markets all around the world into the U.S. market. So the U.S. dollar continues to be the world's reserve currency. As Doug Casey is famous for saying, the worst currency in the world with the sole exception of all of the others. But let's look at the U.S. dollar in isolation, not relative to other currencies. Let's look at the arithmetic around the guarantor of the U.S. dollar, the U.S. federal government. First of all, Steve, the on-balance sheet liabilities of the U.S. government, that is, the money that we owe to the bondholders, now exceeds $36 trillion, or $29 trillion, net of the Treasury's own holdings of Treasury bonds. That number, $29 trillion net, rather than getting smaller, gets $2.5 trillion a year bigger. People point to the Department of Government Efficiency, which, by the way, doesn't exist yet, as the antidote to that. I would urge those people to read a wonderful book called The Triumph of Politics by David Stockman. David Stockman was the head of the Office of Management and Budget during the Reagan years, and details very well how the Reagan Revolution, which truly did enjoy a popular mandate, failed to halt the growth in government. I note that the cutter-in-chief, Mr. Trump, today announced $20 billion in new subsidies for data centers in the United States. Not much of a budget cutter. Where will he get the money? Perhaps from taxpayers in Greenland, at any rate. The big problem isn't that $29 trillion in on-balance sheet obligations. The net present value of unfunded off-balance sheet liabilities, Medicare, Medicaid, Social Security, federal government pensions, military pensions, exceeds, by the estimate of the Congressional Budget Office, $100 trillion. So at the federal level, not the state and local level, not the corporate level, not the individual level, at the federal level, we are $130 trillion in debt. That number grows as to $2.5 trillion a year on balance sheet and another $2.5 trillion a year off balance sheet. Tax the billionaires, says Bernie Sanders. Well, that's interesting math, too. The aggregate net worth of all of America's billionaires is $5.6 trillion. If, rather than raising their taxes, you simply stole all their money, Steve, you would fund the aggregate deficit for a sum total of 1 year without making a difference in the principal. People don't get this. Now, how do you solve this problem? Well, one thing you could do is say to recipients of Social Security, old fat bald guys like Rick Rule, too bad, so sad, we stole the money, goodbye benefits, strong letter to follow. Probably politically unpalatable. If there's anything that the right and the left both agree on, it's stealing from future generations to subsidize current beneficiaries. So if cutting spending isn't palatable and increasing taxes is insufficient, what do you do? In the 1970s, what we did is we honored the nominal value of our obligations, but we debased the purchasing power of the obligation. In other words, we inflated away the net present value of the obligation and honored the nominal value. According to the Office of Management and Budget, in the decade of the 1970s, the U.S. dollar lost in excess of 75% of its purchasing power. So some old geezer like me in 1970, who was receiving $400 in Social Security, continued to receive $400 in 1980. It's just that $400 bought $100 worth of goods and services. Not coincidentally, Steve, during that period of time when the U.S. dollar, the strongest currency in the world, lost 75% of its purchasing power, the price of gold went up 30-fold. Now, it's important to know at the beginning of that decade that the price of gold was controlled. So I would suggest that the move from $35 to $100 was simply removing the legal cap on the price of gold. But the move from $100 to $850, I suspect, was really a consequence of devaluing the purchasing power of the U.S. dollar over the course of the decade. And I believe that past is prologue. I believe that the only way that we can deal with being $130 trillion behind the eight ball and adding $5 trillion a year to the on-balance sheet and off-balance sheet deficit is to reduce the purchasing power. In other words, change the denominator on the national debt. I wish I didn't have to say this. I wish it wasn't true, but I believe it to be true. I'm not suggesting, by the way, that the price of gold will grow 30-fold in this decade, like it did in the decade 1970 to 1980. I'm suggesting a move much more reminiscent of 2000 to 2010, when the gold price increased from $250 to some number like $1,700. But let's have a more modest target, just to make this argument make some sense. I said on your show before, Steve, I don't own gold because I think it might crack $3,000. I own gold because I'm afraid it's going to crack $9,000 or $10,000. I hope my voice is... Oh, one other piece of arithmetic, just for fun, since I've gone on this rant. The market share of precious metals and precious metals securities is at an all-time low in the United States. Less than 0.5% of savings and investment assets in the United States economy are denominated in precious metals or precious metals-related securities, which is to say the market share of precious metals and precious metals-related assets is less than 0.5% of total savings and investment assets. The 4-decade mean, according to J.P. Morgan Chase, is 2%. Gold doesn't have to win the war against the U.S. dollar, or Bitcoin for that matter. Gold doesn't have to replace the 10-year treasury. All gold has to do is return to the 4-decade mean. If it does that, demand for the stuff grows fourfold. What do you do when demand increases fourfold and supply increases by 5 or 6%? I would suspect that the price goes up. But I'll leave that to your listeners to decide.
Okay, so with the combined 100 trillion and 36 trillion and growing by 5 trillion every year, although we do remain the reserve currency, governments, if you look back over history, rather than default, they simply print their way out of it, and they will honor those nominal valuations, nominal commitments. But what that will actually buy you is a lot less. And if past is prologue, gold should do quite well in an environment like that.
That's my suspicion. One of the nice things about gold, Steve, is that in those odd periods when you have a gold bull market, if you think of gold as insurance, a fairly small premium goes a very long way. If in the decade of the 1970s, at the beginning of the decade, one had 5% of their net worth in gold, despite the fact that the treasury market got decimated and the stock market fell as well, you would have come out of the decade having just 5% of your assets in gold, maintaining your purchasing power. You don't have to have 100% of your assets in gold. A fairly small allocation in the event of the circumstances that I've described buys you an awful lot of protection.
Yeah, cheap insurance.
Correct.
Well, that kind of leads us into the next. I'm pretty excited. We've got a new boot camp coming up, and if past is prologue, your boot camps have been very good to our brokerage accounts. So if you like to have fun, you're not afraid of work, and you like to make money, then this is for you. What can we expect at this upcoming Gold Bootcamp?
Well, the disclaimer first. You said if you like to work. If you don't like to work, don't come to the boot camp. If you're the kind of person that used to buy the newspaper to look at the funnies or do the crosswords, the boot camp's not for you. We're going to give you 8 hours of material. Mercifully, we're going to give you recordings too. So rather than taking 8 hours of your life, we're actually going to take 24 hours of your life, because you're probably going to have to play the tapes twice to get all the information. And this isn't going to be a bunch of windy narrative. This is going to be a lot of math, a lot of arithmetic, a lot of description of technique. But if you're up for that, you're going to get a lot of benefit. Your listeners, hundreds of them, have participated in our boot camps in the past: the Silver Boot Camp, the Uranium Boot Camp, the Prospect Generator Boot Camp, the Developers Boot Camp. For people who really care about a deep dive into subjects around investing in natural resources, these boot camps are invaluable, and they're cheap. We charge $99 for a boot camp that can, over the next 10 years, substantially improve your investment performance. And if for any reason You think we didn't earn the $99? It comes with a gold-plated money-back guarantee. The financial risk is mine. The investment in terms of time is yours. We will discuss the why of gold. I believe it's important that investors understand why they are taking the risks and making the capital allocations. If investors know the risks and they know the reason, they are more likely to stomach the volatility that comes with all investments, gold included. And we're going to talk about gold in three contexts. In the context of a savings asset, which is to say physical gold, maintaining liquidity in gold, maintaining your purchasing power in gold. This is all around physical gold. How to do it, what categories, what to look out for, what to be careful about, what to do, what not to do. And then we're going to talk about gold as an investment, buying the highest quality gold stocks in the world, or high quality debt denominated in gold. This is a discussion after savings for investors. And then finally, we're going to talk about speculation in gold, the junior gold stocks. So we're coming to service three different but interrelated investment constituencies: the savers, the investors, and the speculators. And we're going to teach you how. We're going to talk about bullion with bullion dealers. We're going to talk about gold stock investors with veteran gold stock investors, myself included, 50 years in the business. But one last warning. This is 8 hard hours. Steve, you've done our boot camps before. These are not for tourists. These are for committed investors, or I joke, investors who ought to be committed. I really look forward to doing it. And by the way, we have boot camps based on what our customers tell us they want. And about 75% of the respondees, when we asked what topic we should cover with the boot camp, said gold. The market spoke. We are able to produce a very high quality educational product around what the market wanted. So that's what we're going to do.
Awesome. I really look forward to it. All your boot camps are a lot of fun. I see a lot of similarities between this moment in time and when you did the uranium boot camp. I think that gold has quite a bit more to run. We haven't really seen. I mean, we had a nice jump in the majors, from February until recently. But when you look back over history, there's typically some 3-4x returns, and we basically got a double, and then we've since had a sell-off. So I think we got a lot of room there. A lot of meat still left on the bone.
Both Adrian Day and I are likely to observe that the gold equities priced in a historical measure, which is to say enterprise value, which is market capitalization plus total debt, versus net present value, that the gold equities are the cheapest that they have been since both Adrian and I entered the business in the 1970s. If you go further out the speculative ladder into the juniors, well, I think it's arguable that 85% of the juniors have no net present value at all. And we'll talk about that. The 15%, or the 10% perhaps that are legit, are similarly cheap. As I say, we're going to talk to three different constituencies. We're going to talk to gold buyers, then we're going to talk to gold stock investors, then we're going to talk to gold stock speculators. But the last two categories, as you suggest, relative to the gold price, are, I suspect, historically cheap. And in that sense, your observation about the fact that the boot camp comes at a propitious point in time, like our uranium boot camp did, is very accurate.
Yeah, I'm going to share my screen here and just kind of tout your uranium boot camp. So your uranium boot camp came right here. All the up arrows are purchases. But after attending your uranium boot camp, it gave me the conviction to be able to make all these little cheap buys back here, and then also have the conviction to sell it. Now, this is just the Sprott Physical Uranium Trust. This is just the buying the commodity itself. That's not counting, making bets like here, like in URNM. I mean, this was 103% move in short order. UEC, which you had in there, that was a huge bump. We're past the point of concern on that one now. And I think gold is going to have a similar run, and your boot camp for $99. For me, this uranium boot camp for $100, it was life-changing. And I'm hoping for the same in the gold boot camp.
And Steve, importantly, the lessons that you learned in the uranium boot camp and the lessons that you will learn in the gold boot camp won't serve you through just one market. This will be permanent knowledge. And if you use these lessons in conjunction with the lessons in the Rural Classroom, which are free, you will become a better natural resource investor. Now, in order to do that, you have to do the work. You can't, but you haven't. You have to do what Steve Barton has done, which is to say you have to apply yourself to these lessons. You can't just sit through 8 hours. You have to employ the techniques taught at the boot camp. But if you do that, I suspect that it will permanently change both your fortune and your ongoing performance.
Right on. Look forward to it. There will be a link in the pinned comment below. It's Saturday, January 11th from 8 a.m. to 4 p.m. Pacific time. So we hope to see you there. It's going to be a lot of fun. Okay, let's go on to the news of the week here. We have had Justin Trudeau is stepping down, so I certainly didn't shed a tear. What are your thoughts on this?
Well, Steve, as you know, I'm delighted when any politician steps down, even the ones I like. But I'm particularly delighted to see Mr. Trudeau step down. I have a soft spot for Canada. I was educated in Canada. I began my business career in Canada, although I'm American. I've lived in Canada. I've done business on both sides of the border. I have dear friends in Canada. And I'm delighted to see the yoke of the Prime Minister slipped off the neck of Canada. Among other failings, the Prime Minister didn't see the business case for Canadian natural gas. Let's do the math around that. The Alberta gate price has averaged about $2 Canadian for some period of time. That's $2 per million BTU of gas, Canadian dollars, not US dollars. That same gas landed in Shanghai or Tokyo or Rotterdam commanded about 13.5 Canadian dollars. That is, the arbitrage was from $2 to $13.5. It took about $3 to get it there. So $5 gas could sell for $13.5. And the Japanese, the Koreans, the Chinese, and the Germans were begging for it. But the Prime Minister didn't see a business case for it. Good riddance, sir. Good riddance, sir. I think that even though the Canadian oil and gas stocks have had a bump, that investing in the 5-year term in the Canadian natural gas industry or in the Canadian heavy oil industry is a superb speculation. The idea that a new administration in Canada is less hostile to the production and the export of Canadian heavy crudes from the Athabasca Basin, coincidentally with the possibility that the new U.S. administration can debottleneck the Keystone Pipeline and allow the flow of Canadian heavy sour crude to the U.S. Gulf Coast refiners who are desperate for it because they tooled their refineries to process heavy sour Mexican and Venezuelan crude, which is no longer available on the market, is an absolutely superb potential arbitrage. I'm not saying that Mr. Trump is going to be able to restart the Keystone Pipeline. What I'm saying is that if he is able to, and if a Canadian administration is more interested in growing Canadian wealth and allowing the production and the sale of Canadian hydrocarbons, the boom that you could see in the Western Canadian Sedimentary Basin over the next 5 years could be absolutely incredible. The impediments to Canada's success in oil and gas had nothing to do with human resources. Canadians are absolutely superb in extractive industries. They export their knowledge and technology around the world, and it has nothing to do with geology. The Western Canadian Sedimentary Basin is one of the great conventional oil and gas basins in the world. It had everything to do with politics. And the chief personal impediment to that success, Mr. Trudeau, is, mercifully for Canada, I would suggest pursuing other employment opportunities. Now, our listeners need to consider all of the alternatives. One is that he could be replaced by somebody worse. If you look at Canadian voting patterns over the last 40 years, what you see is that what I would describe as the consolidated left in Canada. The Liberals, the NDP, a traditional socialist party, the Greens, an environmental socialist party, and the Bloc Québécois, a French nationalist, and I would suggest socialist party, regularly commandeers 60% of the Canadian vote. So there is a chance that a successor to Mr. Trudeau could appear and consolidate those four parties and govern with a minority party, much like the Liberal has done in the past. My worst fears is that a man named Mark Carney becomes prime minister. Mr. Carney, for those who don't know, is a competent statist, whereas Mr. Trudeau was an incompetent statist. If there's anything that scares me more than an incompetent statist, it's a competent statist. My hope is that the conservative candidate, note too that I'm no conservative, I'm a libertarian, but my hope is that the lesser evil, which is to say the conservative candidate, Mr. Poilievre, who is from Alberta, ascends to being prime minister and governs much in the way that previous conservative governments have governed, which is to say, not really to my liking, but much less to my disliking. The Harper years in Canada, the prior conservatives, were not a period where government shrank. They were merely a period like under Reagan, where government grew less aggressively. And that's all Canada needs. It just needs the boot off its throat.
Okay. So you're not shedding a tear either. And there is a chance that we could get someone worse. That would be the worst case. That would be Mark Carney. We're keeping our fingers crossed for Pierre. How do I pronounce his last name? Poilievre. Poilievre. And maybe that will de-bottleneck the arbitrage that we could have from getting $5 per million BTU natural gas over to China and to Europe, and make quite an arbitrage there. Now, you mentioned Trump possibly being able to de-bottleneck the Keystone Pipeline. So that's basically a pipeline that goes from Canada and takes it all the way down through America into the Gulf Coast. And each of these refineries are kind of specific, right? They can either take like light sweet crude, or they can take heavy sour crude. I mean, it's high in sulfur. And we have the capacity, if I'm not mistaken, to be able to refine this heavy sour crude from Canada, just like we were doing from South America, right? But since we don't have that anymore, if we can open up the spigot on the Keystone Pipeline and refine that kind of similar property oil, then that could be a real moneymaker, right?
A win-win-win. These heavy sour crudes are cheaper than sweet crudes. American oil companies spent billions of dollars building this capacity to produce Venezuelan crude and Mexican crude. That crude, as a consequence of underinvestment by the national oil companies in Venezuela and Mexico, is no longer available to us. This crude is cheaper. We've already spent the money to process it. So this would increase the cash flow of the refiners, lower the price of gasoline and heating oil and other products, asphaltenes as an example, for the American consumers, while greatly increasing the profits of the Canadian producers.
Okay. Who do you see as the main beneficiary to that? Would it be like Peyto, Birchcliff, Tourmaline? What do you see?
Peyto, Birchcliff, Tourmaline in the natural gas trade. In the heavy oil trade, it's Canadian Natural Resources and Suncor.
Okay.
And also a smaller one, International Petroleum, which by the way, is a Lundin vehicle.
Oh, okay. All right. Kind of a double whammy there. Now, with the Keystone Pipeline, what's the big holdup on this? Why would there be any doubt that this could happen? Is it because you have to run through 5 different states and get approval of 5 different governors and constituencies to open this thing up, or?
I would say that there are 4 potential problems. The first has been an objection in Canada among people who are anti-hydrocarbon. My suspicion is that objection becomes less prevalent. The second is the opposition in American federal circles of people who are similarly anti-hydrocarbon, people who would like to see less burning of fossil fuels. Interestingly, those people often fly private jets to Davos to tell us to drive less. But they're a real problem. There's a lot of them. They're very well funded. Some of them are very well meaning, by the way. A different problem is state legislatures. This has to go through, as you point out, several states. Note that we're not building a new pipeline. We're just debottlenecking an existing pipeline. And there are a couple of environmental flashpoints. Tunnels underneath rivers, as an example, need to be engineered very, very, very correctly. Because if there's a mistake, it has the chance to be a catastrophic mistake. Note that those tunnels are already in use, transporting crude. In this case, from North Dakota, south, American crude, as opposed to Canadian crude. And then there are the objections of some private landowners, including American Indian tribes. The American Indian tribes, in particular, feel, among other things, that they are improperly compensated for the use of the land that is used to transport oil and gas. And Mr. Trump, were he to attempt to get Aboriginal and indigenous people on sides, would probably have to agree to a different form of revenue sharing. It is true around the world that resource development has created a circumstance where the social rents mostly go to the center, which is to say Washington, D.C., and the regions get the shaft, a mining descriptor. And the idea that more of the transmission revenue, which flows to Washington, would have to flow to the states or the landowners is probably in order, looking at it from a historical viewpoint. Hopefully, if this discussion comes to pass, Mr. Trump would be able to mediate a dispute between the center and the regions, particularly given that virtually all of those states voted for him.
Okay, well, that's good news. That's one of the one of the hangups there. Okay, so Canada could be the problem. The U.S. federal government and the people that are against driving cars, state legislatures going down the line, and then just random local problems such as American Indian tribes wanting a cut, and they put these tunnels underneath rivers, and we got to make sure that they're safe. So. That's interesting. Okay, now I also noticed that Devon has finally caught a bid. I see them doing okay. Tell me if you concur. As long as oil remains above $60 a barrel, then Devon should be doing pretty well. Is that about the right number?
Yeah, that number's fine, but you got to look at the natural gas number for Devon. Okay. Natural gas has caught a bid too. Natural gas is up about 40% last 6 months. And Devon is, importantly, a gas producer, a swing gas producer. Devon, even at very low prices, as a consequence of how efficient it is in the oil business, has been making great money. But the leverage in Devon is all about natural gas.
Okay.
And natural gas is going to be volatile. There's nothing to say that the gas price can't fall as we drill more oil wells. But looking at it from a longer-term point of view, these very low gas prices that, depending on your point of view, we have either enjoyed or suffered, have changed the dynamic in the gas market. We have spent billions of dollars on gas gathering, on gas storage, on gas infrastructure, on liquefied natural gas transmission facilities, at the same time that, in particular, German manufacturers who no longer have access to cheap gas have been shutting down their factories in Germany and opening them up in the U.S. to take advantage of this gas. In other words, moving the production to the gas as opposed to moving the gas to the production. The gas market is changing right in front of our eyes. But because people's minds are focused on the next 3 months rather than the next 3 years, nobody's paying attention. Devon is a 3-year story, not a 3-month story.
Okay. Okay. And you don't see any concern because Devon's had a sell-off from its recent highs that's more bullish.
The big concern is a synchronized global recession or depression that cuts demand for all industrial materials and all economic activity. You can have reduced supply if you have reduced demand and the price doesn't move. I will leave it to your listeners to do the economic analysis. I'm not an economist. I'm a lender. From a credit point of view, from an arithmetic point of view, the natural gas trade is an unassailable point of trade if we don't slip into a global depression.
Okay. Okay. Do you see any risk of Devon being bought out by like Exxon or Chevron if they continue to have some weakness?
This would be a wonderful year to do it. Early in the Trump administration, when antitrust enforcement is likely to be more lax than it was in a Democratic administration, Devon would be a very, very, very big bite. And you look at who the potential buyers would be: Exxon, Chevron, perhaps Occidental, backed by Buffett, but it would have to be a very constrained group of players who could play a game that big.
Okay. All right. Only a few possible buyers. Okay, I want to share my screen here and move on to copper. And one of our listeners, Blaine, found an arbitrage that we've been enjoying. So this is the Sprott Physical Copper Trust, and this brown line right here is the share price. And if we go down here to the blue line, this is the net asset value. So when this came out, I was tracking this for a month or so, and I didn't have a whole lot of interest in buying something that was more expensive than it was. But what's happened here since the beginning of November is we found a real arbitrage, and this is when Blaine let everyone know. And this thing is trading at a pretty massive discount. Got north of 20%. And if I go to the chart here, I'll pull up the copper. So this is the spot price of copper. And now this isn't updated today, but basically you could buy $4.20 worth of copper, but it only cost you like $3.50. And here's the Sprott Physical Copper Trust right here. We're basically just buying this on the way down. This last limit order here didn't hit. So the discount isn't north of 20% anymore. I think today it's 14 or 15. Am I crazy here? Is this a sweet deal? What do you see, Rick?
Traditionally, buying an asset at a 20% discount to its price is a fairly good deal. Copper itself is very sensitive to the global economy. And if you think that there are near-term risks to the global economy, you shouldn't be looking at copper products at all. I would note, too, that the Sprott Physical Copper, I would note, first of all, in terms of conflicts of interest, while I'm not a Sprott officer, director, or employee, I am the largest shareholder of Sprott, I think. So that anything I say about the Copper Trust needs to be listened to in the context of a Sprott shareholder. To the extent that listeners to this broadcast buy the Sprott Physical Copper Trust, and I'm a Sprott shareholder, I enjoy the management fees from that trust, I benefit. So let's get the conflicts out of the way. Having done that, buying any of the Sprott trusts over the last 15 years when they sold at 20% discounts to net asset value has invariably been a very pleasant activity, assuming that the copper price doesn't fall off a bridge as a consequence of some global economic slowdown. I will say that there's not a direct relationship in terms of holding copper with the Sprott Physical Trust, because the expense ratio in the Sprott Physical Trust, if you include the management fees, the storage fees, the insurance fees, all that kind of stuff, is almost 1%. So one, in many circumstances, could expect a very modest discount. It turns out that institutional investors told us, I shouldn't say us anymore, told Sprott that the Sprott Physical Trust was, in their point of view, the most efficient way for them to buy and hold copper because we did all the work for them. Sprott bought it, Sprott stored it, Sprott insured it, and you could buy it and sell it with the click of a mouse on the exchange. But people do need to understand that this is not expenseless. There are management fees, storage fees, insurance fees, shipping charges, all that kind of stuff. So there's not a direct linear relationship to the Sprott Physical Trust vis-a-vis the price of copper over the 5 or 6 year time frame.
Okay.
However, your basic thesis is very good. In my experience, I watched the Sprott Physical Gold and Silver Trust, the former CEF Trust, traded at a 20% discount to net asset value, and I watched the Sprott Physical Uranium Trust trade at 20% discounts, and both of those had very, very, very pleasant moves. In the case of uranium, that move was magnified by virtue of the fact that the uranium price itself went up threefold. So you bought something at a 20% discount that then itself had a threefold increase. It was extremely pleasant.
Yeah, let's wrap up with that. So uranium. I noticed the same thing. We had a recent, I could pull up the chart, I guess. We had a recent a discount coming in here for the Sprott Physical Uranium Trust. And here's the spot price of uranium. So we could see it was hanging around $80 for months, and then it shot down around Christmas time and got down to 70, and we've since corrected up a little bit to 74, 75. But when I was talking with Justin Hune, who follows this market probably as well as, a couple dozen people on the planet, he was saying that the term pricing going out into the future, 12 months or more, was 81, and that was the lowest bid for last month. So that means that there was contracts that were even north of that. Was that a moment in time? I placed another bet here on the Sprott Uranium Trust around that moment. What are your thoughts on this?
Justin makes a very good point. Not necessarily merely just around the Sprott Physical Uranium Trust, but the truth is that when you look at the price of uranium, it's becoming more and more opaque because the pricing terms on the contracts aren't readily available to people who aren't willing to do the work that Justin does. The discrepancy between the contract prices, most of which are inflation adjusted, in the low 80s and the spot price in the mid 70s is becoming broad enough that it's not unlikely that commercial interests will buy the spot and sell it in the term market. In other words, there's an arbitrage there between the $74 spot price and the $81 or $82 term price. And to the extent that actors in the spot market can get sufficient quantity and are well enough capitalized, that arbitrage will be arbitraged away. It's important to note that the spot market, although it's still the reference point for the trades, is becoming increasingly irrelevant. Most days, the dollar volume in the Sprott Physical Trust is greater than the dollar volume in the spot market, which is to say, the spot market is becoming the Sprott market. And increasingly, the amount of inventory available for resale is decreasing, largely, as we suggested on your show 3 years ago, as a consequence of the restart of the Japanese nuclear fleet. That inventory, which had been held for resale because the Japanese weren't allowed to use it, would show up through Itocho, and most of the fills when the Sprott Physical Uranium Trust was out buying physical uranium was Japanese material. That Japanese material is now being diverted into Japanese restarts. So the overhang on the physical market looks like it's coming to a close. The second thing that probably impacts the physical market in the near term is the fact that the Inkai mine in Kazakhstan, a joint venture between Kazatomprom and Cameco, has experienced real startup problems. Startup problems that I thought wouldn't occur, by the way. I, I thought that the biggest production bump that we would see was going to come out of Inkai, but that hasn't happened. And there appear to be a couple problems. One problem is that one of the elements required to make it work is sulfuric acid. And sulfuric acid is in tight supply globally. Cameco, a party to the Inkai joint venture, has refused to use Russian sulfuric acid as a consequence of both Canadian and U.S. sanctions against Russia. The Kazakh partners have said, we're not a party to this dispute. And if we can't use Russian acid, we have to pay $20 or $30 a ton more for other acid, which is unavailable at any rate. So there's a huge dispute between Cameco and Kazatomprom. Kazatomprom suggesting that the extraterritorial imposition of U.S. and Canadian political preference on Kazakhstan is unwarranted. And Kazatomprom has their own problems. I'm not sure what they are, but the exodus from middle management in Kazatomprom, which has happened over the last 2 years, is very troubling to me. All of which means that a lot of the material that I had thought would come on the market as a consequence of the unfettered restart of Inkai isn't coming on the market.
How many million pounds would that have been? Do you know?
I anticipated that Inkai would produce 12 million pounds a year.
Oh, wow.
And it isn't producing anything like that. I had assumed that because it's in effect a water flood, an ISR deposit, that Inkai would both replace the production that they produced in the $20 to $30 environment, and in fact, implement new well fields and increase the production. They haven't been able to approach pre-shutdown levels.
Okay. And to put that into perspective, we're consuming 180 to 190 million pounds a year across the planet. So 12 million pounds is a significant amount.
Significant amount. And it could be that they solve this problem. It could be that the Canadians agree with the Kazakh position, which is to say that they should be able to use Russian smelter acid because Kazakhstan is a neutral party to the disputes. I mean, I don't know how or if this resolves itself. I just know that the dispute between Cameco and Kazatomprom, which was a private dispute for 18 months, has become very public and very acrimonious.
Okay. Okay. All right. Maybe the shakeup with Trudeau will help unbottleneck that. But in the meantime, I'm really liking my Sprott physical uranium recent bet. Okay. Okay. All right. Let's go into Boca Raton. I'm already excited about that. I just got a message from Barbara recently letting me know that the tickets were available. I was probably one of the first to get them. So tell us about Boca Raton.
Well, I would humbly suggest, or not so humbly suggest, that the Natural Resources Investment Symposium, which is the official name for Boca Raton, is the best natural resources investment conference in the world. We've put it on for something like 30 years. It's got a little better every year. And if you do something every year for 30 years, with 1 year out for COVID, it gets pretty good. And it's really good. Like our boot camps, it comes with a complete ironclad money-back guarantee. Whether you attend in person, which is what I would prefer, or online, which is obviously more convenient and sometimes more comfortable. If you don't believe that I've earned my tuition fee, email me and I'll refund your tuition. I'm delighted to say in 28 years of money-back guarantees, I've had to refund less than 0.1% of the tuitions I've charged, but that nonetheless is the offer. Why is it so good? Well, several reasons. First of all, we have great big picture thinkers. The, Daniela DiMartino Booths, the Nomi Prinzes, the Jim Rickards, the Bill Bonners of the world, telling you the way the world really works, not the way the big thinkers wished it worked. And then if you agree with that big picture premise, we have wonderful analysts, people who have been active in natural resource investing, oil and gas and mining for 40 years, telling you how to implement the strategies around those big picture perspectives. More importantly than that, you will be joined at the symposium on the floor by 500 high net worth intelligent attendees. The idea that all of the knowledge at the symposium flows from the dais out to the crowd is stupid. The attendees themselves are wonderful sources of information. Paying attention to the questions that they ask and the answers they receive, participating in the share of knowledge, traditionally has been very rewarding. At our conference, unlike any other investment conference that I know of on the planet, every single exhibitor has been vetted. The attendees have told us that our exhibitors are content too, which means that any public company exhibitor that appears on our floor is owned physically in the accounts of the people that put on the conference, principally my own. There's no guarantee that because I own something, the share price goes up. There is a guarantee that I understand it well enough that I own it personally. That doesn't mean these are riskless. I'm a risk taker. What it means is that every single public company exhibitor has been vetted. Similarly, every provider of services, every bullion dealer, every coin dealer, every broker, are people that I have never received a customer complaint about in 45 years of natural resource investing. One complaint, adios. The guy's gone. We had an exhibitor 3 years ago that got 3 or 4 complaints from the attendees. Gone. So for those reasons, this is a must-attend event. As I say, you can attend in person. And by the way, I would really, if you can do it, suggest that. I had an attendee 5 or 6 years ago email me and say, Rick, I should talk about the living legends too. Well, I'll finish my story, but saying, Rick, following Robert Friedland around the exhibit floor and seeing what exhibitors a billionaire stopped in front of and listening to him ask questions of the exhibitor was worth my whole price of admission. I got the rest of the conference for free. One of the great features of this conference is the living legends, where the Robert Friedlands of the world, the Lundin families, the Sean Rosens, the Bob Quartermains, the Ross Beatties, join me on stage and talk about how they built multi-billion-dollar companies up from penny stocks, not just beating their chest, but telling you how they did it and why those lessons matter to you, how it changes them as an investor. This year, I'm expanding it. In addition to having a Legends panel around mine builders, I'm going to have the legendary investment panel, where investors who've made hundreds of millions of dollars or billions of dollars investing in natural resource stocks will be impaneled and asked educational questions. What risks they took, what lessons they learned, what mistakes they see other investors make, how the lessons that these billionaire investors have learned can benefit you in the construction of your own portfolio. This has never been done before, and I think it's extremely valuable.
I'm looking forward to it. I attended my first one last year. It was the best conference I have ever been to. The boat cruise was amazing. That was a lot of fun. You get to meet, in person with a lot of the people that you're talking about, and of course the people that attend as well. And like you said, the 500 attendees or so, there's some highly intelligent people in there. A lot of them are geologists, and you can ask them about the companies listed, and they'll tell you they've walked the sites. I mean, it is really, really a lot of fun, and just a great conference.
I should also say, Boca Raton in the summer is probably nobody's idea of good weather. But that's okay, because I'm not going to let you go out anyway. You're going to be working very hard at the conference. The fact that I have the conference in Boca Raton in July means that one of the finest hotels in the world the Boca Raton Resort, is available to our attendees for $320, $330 a night. If you rented a room there now, it'd be $1,200 a night. The physical facility around the conference is spectacular. It's absolutely spectacular. And early mornings and late evenings, including the boat cruise, the weather in South Florida turns extremely nice. When I'm not absolutely cramming information into your ears, going up and down the Intercoastal Canal with the speakers on a wonderful, great big boat, drinking booze supplied by me, is a pretty good deal.
Yeah, it was a lot of fun. And yeah, like you said, the resort's a lot of fun. The missus and I, when it was over, we went and got some inner tubes and went around the little lazy river. They got water slides. I felt like a kid again. A lot of fun. Link will be in the pinned comment below. I hope to see you there in July. And the Rule Classroom. Do you have to go, Rick?
I do.
Okay.
I have another appointment a couple minutes ago.
All righty. Well, we will let you go. Rick, this is always a pleasure. I will see you in the Rule Classroom tomorrow and at 1:30 Pacific time. Thank you very much, Rick.
Steve, one final message. We've repeated it many times, but any of your listeners who care what I have to say about natural resources, oil and gas, mining, gold, whatever, are reminded that you can go to ruleinvestmentmedia.com, list your natural resource stocks, and I personally will rank them 1 to 10, 1 being best, 10 being worst. This service is absolutely free, so for sure, you'll get your money's worth. Ruleinvestmentmedia.com, list your natural resource stocks, no crypto, no pot stocks, no tech stocks, just natural resources.
Awesome. Thank you, Rick. We will put all the links down below, and I will see you tomorrow in the classroom.
Thank you, sir.
All righty. And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.